Hi, welcome. These are webcasts to accompany the new edition of my book, The Little Book of Valuation. In this session, I want to focus on Chapter 1, where I introduce you to the idea of valuation, talk about why we do it, and provide what I call the philosophical foundations for valuation. So let's get the show on the road. If you think about it, most people go through life without ever valuing a company and they live perfectly happy lives. So if your question is, do I have to value a company or value a business? Not really. But it is true that if you're a sound investor, that one of the postulates is that an investor doesn't pay more for an asset than what it's worth. I don't think anybody would disagree with that statement, but it's kind of empty if you don't figure out how to estimate what something is worth. In other words, you have to try to value something if you want to buy it before you buy it, because after you buy it, it's too late. I know there are lots of people out there argue that you can't really value companies, that what you see as the price is what people believe it to be. It's in the eye of the beholder. And if you're looking at a Picasso, that's absolutely true, right? You and I can argue about the intrinsic value of a Picasso, but the truth is, it is going to be worth what demand and supply sets it to be. I'm not going to disagree with the notion, but I'm going to argue that if you're an investor, you have to disagree with that notion. There is a value. You're going to try to estimate it. If you're a trader, and we'll talk about the distinction, you might care just about what people think about the value of something. In other words, the eyes of the beholder. So let's set that process up of value versus pricing, because this is a theme you'll see me returning to over and over again. Intrinsic value of an asset is what you would pay for a business or an asset based on its expected cash flows. In pricing, you decide how much to pay for something based on what other people are paying for similar things. If you think about it, much of life is pricing, right? When you decide to buy a house or an apartment, how do you decide how much to pay? Well, you don't do an intrinsic valuation. You look at what other people paid for similar apartments or houses. I'm going to argue that much of what passes in the market out there as valuation is really pricing. It is true that intrinsic valuation gives you a much fuller idea of what a business is worth. But it's also true that pricing might give you a more realistic estimate of what you can get for something today out there. So rather than dismiss pricing, I'm going to talk about both how to value things as well as how to price things. Now, why should you care? I think knowing how to value assets is useful for all people, including traders, and here's why. For investors, it's central to what you do because it determines what you buy and what you sell. You buy things that are undervalued, you sell things when they're overvalued. For traders, valuation might be secondary, but I think it can still be useful because it can tell you when to buy and sell, when to detect shifts in moods and momentum. And we can talk about the role that valuation has in a trader's toolkit later in this process. In corporate finance or running a business, there is a role for valuation in almost every aspect of the business. If you're a founder of a startup and you're thinking of raising capital, you have to know what the value of your business is before you access that capital because you're going to be giving up a share of your ownership and you don't want to give up too much. Once you're established, to make your decisions on where to invest, how much to raise in debt, how much to pay in dividends, those decisions are going to be colored by how they affect value. And even accounting is not immune. The big move in the last few decades is towards a fair value accounting, though we will come back and ask the question, is it really fair value accounting or fair price accounting? But the objective seems to be to mark up things on the balance sheet to reflect what they're worth today. So I'm going to start off this particular book by laying out three basic themes or principles that I think drive valuation. And I think they cut to the heart of three misconceptions that many people have about valuation. First is, many people think valuations are objective. The truth is that all valuations are biased. I know you're getting defensive. You're saying, I'm going to be objective. You can't be objective. And here's why. When you pick a company, already you're biased because you picked a company for a reason. You read about it, you listened to somebody talk about it on CNBC. The choice of a company itself is going to open the door to bias. And the more you learn about a company, the more you read what other people think about a company, the more biased you will get. Where does it show up? Everywhere. As we will see, when you value a company, you have to estimate cash flows and growth and risk, and you come to choices. And the choices you make will reflect how much bias you bring into the process, or what kind of bias. Now, after you're done with the valuation, and this is common practice, you'll see people do what I call valuation garnishing, adding premiums for what? For control, for great management, for brand name, or reducing value by discounts for what? Illiquidity, bad management, private company. I'm going to argue that the process is open, rife with bias, and the more biased you are, the more you will be able to change the numbers to reflect the bias. You might say, so what? If you're looking at somebody else's valuation of a company before you look at the numbers, you might want to think about why they did the valuation and what kind of biases they bring to the valuation. If you're doing your own valuation, at least be honest with yourself about the biases you bring in. So all valuations are biased. Second, there is this misconception that if you do a good valuation, you will get a precise estimate of value. Or conversely, if your valuations are imprecise, you must not have done a very good job. That is not true. And here's why. When you value a company, a great deal of what you do is out of your control. In other words, you can do everything you can to get your best estimates on growth and cash flows, but you're going to be wrong. You're going to be wrong because the future is uncertain. And even if you envision the right path for your company, there can be macro shifts that throw you off. Imagine valuing a hotel company in late 2019. You could have done everything right. But you know what you'd have done built in? The possibility that a few months later, COVID would shut the global economy down. And also the amount and the type of uncertainty you face will vary across companies. If you value a company with 50 years of history with a stable business model that's making money, your valuation is going to be a lot more precise when you value a young company that's still finding its way to a business model. You might say the first valuation is better than the second. Why? You did your best in both cases, and the fact that you value the first company more precisely might not give you much of a payoff because everybody else valuing that company has exactly the same resources, the same advantage when they value companies. All valuations are wrong. The question is by how much? And even if they're wrong, they're not a reflection of the quality of the valuation because it might be things out of your control. Which brings me to my third misconception about valuation. Especially in the last few decades, it's become easy to build big models, complex models. And there's this perception that if you build a bigger, more complex model, you must get a better value than if you use a simpler model. That's not true. The truth is, less is more. Simpler models often do better than more complex models. I know that doesn't mean you shouldn't build in complexity, but I have a simple rule. Never add more detail than you absolutely have to. So whenever you come to an input where you're trying to estimate detail, ask yourself, do I have information to add something to the valuation? And if you don't add that detail. So valuations are always biased. Precision is impossible to find in a valuation, and less is more. So here's what I'd suggest as you get ready to read the rest of this book. It is true that most people choose not to value companies. They come up with all kinds of excuses. There's too much uncertainty. I don't know enough finance. We're going to argue that in this book at least, anybody can value companies. If you choose not to value companies, you cannot use the excuse of, hey, I don't know how to do valuation. It's too complicated. Valuation at its core is simple. Anybody should be able to do it. And in hindsight, will you be wrong when you value a company? Absolutely. Sometimes you can say it's your fault, but most of the time it's things that you don't control. So in this book, we're going to talk about valuation. We're going to talk about how to deal with uncertainty in healthy ways and make your best estimates of value. So I hope to see you along for the ride for the remaining 11 chapters of this book.